Welcome to the Build Your Private Practice podcast, a space for Canadian therapists who want to support others, make an impact, and build a sustainable practice that works for them too. I'm your host, Liane Wood, a registered psychotherapist, group practice owner, and business mentor, and I'm here to help you build a private practice that allows you to keep doing the work you love without burning out. Because the people who need your help the most are counting on you, and you deserve a practice that supports you while you support them. Let's dive in.
This episode is brought to you by Jane, a practice management software and EMR built for the real everyday work of running a mental health practice. A question for the practitioners. Does your day actually end when your last client leaves? For a lot of you, the answer is likely no, and that is something Jane can help change. With Jane, you set the schedule for what works for you. Customize your session types and times and automate the things that slow you down, like sending reminders and gathering intake forms. Jane takes care of it all before and after your appointments, so you're not cleaning up admin at 9 p.m. And with AI scribes supporting your documentation, your notes get done while the visit is still fresh in your mind, not at the end of your day. To see how Jane can support the business side of your practice, head to jane.app/explore. And if you're ready to start, use my code BYPP2MO for a 2-month grace period on your new account.
Well, welcome to the Build Your Private Practice podcast. I'm your host, Liane Wood, and I'm so glad you're here. I want to start today with a word that comes up more than most any other when I talk to therapists about money, and that word is guilt. Guilt about charging a real fee, guilt about wanting more than just enough, and guilt about the idea that building wealth and caring deeply about your clients somehow can't live in the same body. A lot of us went into this work to help people, and somewhere along the way, we picked up the belief that wanting financial freedom makes us less of a helper. So today, we're going to gently take that belief apart because the truth is, a financially steady therapist is a better therapist. When your own cash flow isn't keeping you up at night, you have so much more to give the people you're helping. My guest today is Kris Sabramsky. Kris is a certified financial planner and the founder of Therapist Financial based in London, Ontario. He spent more than 20 years in financial services, and for the last several of those, he's worked almost entirely with therapists across Ontario, more than 100 of them so far. So he knows the realities of session-based income, the cancellations, the no employer pension, the late night money decisions after a long clinical day. And he's here to walk us through how to build real lasting wealth on top of that without the guilt and without the hype. So Kris, welcome. I'm so happy to have you here.
Thank you, Liane. It's great to be here. I'm honored to get a chance to speak to you about this.
Amazing. Well, before we jump into the money side, I'd love for our listeners to get to know you a little bit. So, can you tell us a little bit about you and about Therapist Financial, who you work with, and what drew you to focus on therapists?
Sure. So I first got into the business as a financial planner back in 99. So I've been
Mhm.
doing this a long time. And over the years, as my business has grown, I started naturally talking to more therapists, more on the insurance side, probably as of 2016, 17. A lot of disability, life insurance and that stuff. And just in talking to therapists, as COVID happened, a lot of people were going private practice, and there just seemed to be a lot of confusion and a lot of they didn't feel clear about their financial situation. Nobody teaches this in school, and here they are trying to juggle building a business and managing their personal finance all in one, and just seemed like nobody was helping. So that's where Therapist Financial came from. We're dedicated to working with therapists, trying to help provide that clarity and reduce the anxieties when it comes to financial planning and retirement planning and even getting organized with your business. I feel like this is a big topic that I hear often is just everything's coming into my bank account and it's all coming out and I don't really know where or why or how, and I just need some clarity. So we're
Mhm.
trying to help provide some clarity.
I love how you just said you're helping to reduce therapists' anxiety and
Yeah,
bring that,
that's
that
good.
clarity.
Yeah, yeah.
That's
Yeah.
amazing. That's
Yeah.
amazing.
I mean, money obviously causes a lot of anxiety for everyone. So
It
not just
can.
therapists,
Yeah,
but
yeah,
yeah, it's
yeah.
we're trying to reduce that.
Amazing, amazing. I mean, you've worked with a lot of therapists now. So tell me, what's the most common money story that you see with therapists? Like the thing that you hear again and again?
Yeah, well, the sort of being unorganized, I think, is probably the biggest one. I mean,
Hmm.
I don't feel like anyone's really got structure. I shouldn't say anybody. There are definitely some really organized therapists that I've come across, but there are a lot that seem to come to me for help are looking to get some structure because they don't really know where their money's going. They don't really have any way to keep track of it. They don't feel like they're on track for retirement. They don't
Hmm.
really understand how to invest money. There's just a lot of those unknowns. And so they're just looking for someone to help guide them. So that's probably what I hear most. There's a lot of conversation as well about should I incorporate or not, and when, and how, and why. And so this is another big topic. But really,
Hmm.
it's the unorganization, I feel like, is probably what I hear most.
Is it unorganization or not having a system?
Well, I guess that would tie into if there was a system, you would be more organized, you would feel more confident with what you're doing, you would have a better understanding of where your money's going and
Hmm.
whether or not there's any money left over to put towards something like a retirement plan or whatever your goals may be. So, yeah, it's definitely
Hmm.
not having a system, I guess is the better way to say it.
Yeah, well, I just as you're talking that, I'm like, maybe it's, having that system piece there. And the word that I kind of opened this episode with was guilt, because so many therapists feel a real tension between being a caring helper and wanting to build financial security, almost like the two cancel each other out. Do you
Hmm.
see that? And how do you help someone start to loosen that grip or that belief?
Yeah, I mean, I see it a little bit. To be honest, I've read more about that than I've
Mhm.
experienced in real life. I mean, I don't have a lot of
Mhm.
therapists saying to me, I feel guilty making money. I feel guilty trying to build wealth. But it
Mhm.
definitely is out there. There are those who struggle specifically, I guess, with their fee and what they're
Mhm.
charging because they
Mhm.
don't want to charge too much for many of these guilt reasons that you just mentioned. So,
Mhm.
I like to frame it, if you do raise your rates a little bit and you maybe lose a client, I mean, that's a lot less devastating than having to shut down your practice and losing all your clients because it's just not financially stable and you can't pay your bills. I don't know how you can give yourself, to a client and be there and present when you're so stressed about money and struggling behind the scenes. It's just, I feel like it's hard to really put your best self forward and be there for the people that you're working with. So I think
Mhm.
it's, very important to not feel that guilt because you sort of have to take care of yourself as well if you're going to help others.
Yeah, I agree. I think that the financially stressed therapist shows up very differently in client sessions than a therapist who is not struggling financially. And I'm not saying that to mean you have to be living this lavish lifestyle of the rich and famous, but
Yeah,
just stable financially, right?
for sure. Yeah. I mean,
Yeah.
making sure your taxes are paid, making sure you're on track for your goals in retirement. I mean, that just gives you peace of mind and having
Hmm.
that plan and those processes help with that. It's an interesting concept. I mean, when I read the Profit First book, that was the first thing that they started with was the financial
Hmm.
guilt that therapists feel. So I
Hmm.
sort of went on that journey. I always ask people, I mean, how
Hmm.
do you feel about money? Do you feel guilty making money? And to be honest,
Hmm.
I don't hear it as often as I thought I would.
Okay. Yeah. Well, there is kind of this quiet belief for therapists, that wanting financial freedom is somehow not okay in a helping profession. We're here
Hmm.
to give, we're here to help. And so this idea of financial freedom is like, oh, I'm not sure that that's okay.
Yeah.
So, what would you say to a therapist who's listening right now, who feels that, who wants more financial stability, but is feeling a little bit ashamed of wanting it?
Yeah, well, the journey that I went on that I think could help therapists is if you really think deeply why it matters, why do I need money, and what can it do for me? What am I trying to achieve in life? What will make me feel happy? I don't think that it's a bad thing when you're trying to build wealth or financial freedom so that you can live a happy life and not just for yourself, maybe for your spouse and children or partners. It's all about living a good life. And that's kind of how I see money is I'm not trying to be rich. I'm not
Hmm.
trying to be a millionaire. I'm just trying to fund the things in my life that I enjoy, like travel, for example, and having that ability to afford a vacation with my family and give them those experiences and spend time with them. I don't feel like that's something I should feel guilty about. And I
Mm-hmm.
think, if therapists can find their why when it comes to money and how
Mm-hmm.
much is enough to fund the lifestyle that you want, I don't see anything wrong with that
Yeah. Yeah, exactly.
because that's what everybody's trying to do. So,
Absolutely it
you
is.
know,
Yeah.
and there's a lot of other occupations out there, me included,
Mm-hmm.
who I'm providing a service to help people, and
Mm-hmm.
not everybody can afford to
Mm-hmm.
pay for financial help, and I deal with the guilt as well. And
Ah,
so I feel like
yes.
we're in similar scenarios, my industry and yours, because
Yeah.
we're trying to help people too. But at the
Mm-hmm.
same token, I still
Mm-hmm.
have bills to pay. I still have children to raise, and
Mm-hmm.
so
Mm-hmm.
I
Mm-hmm.
can't just think all about the clients 100% of the time.
Right. Okay. Okay. Now, you talk about financial planning as adding structure and clarity. And
Hmm.
so, for a therapist who hasn't had a real plan, hasn't had that structure, who's just been maybe winging it month to month, what does a financial plan actually do for them and what changes when it's in place?
Well, I use the word clarity because
Mm-hmm.
really there would be clarity once you're at I don't want to say the final stage, but once you get that base plan set up. But a lot of, most people are not organized financially. They're not keeping track of their cash flow. I don't like to use the word budget because it's not really something that has shown over time that it provides long-term success, but you do need to understand where's your money going, how much do you earn, what are you paying out, and when you do the plan, the baseline plan, what it does is gives you sort of the starting point, which lets you know here's where you are today.
Mm-hmm.
And just sometimes seeing that really helps. And it does provide that clarity of, oh, okay, it's not as bad as I thought, or maybe it's worse than I thought. But either
Mm-hmm.
way, you
Mm-hmm.
know. And
Mm-hmm.
then you can start implementing strategies to try and get you on track if you're behind track. And that peace of mind that comes with start checking all those financial boxes really is powerful. There's less anxiety. There's a lot of research on it as well that those who are planning feel more secure than those who don't plan. There's a lot of research that shows those that plan reach their
Mm-hmm.
goals quicker and are more
Mm-hmm.
successful than those who don't plan. So
Mm-hmm.
so that's kind of how the process works. You get that baseline, you get an idea of where you're at. And again, it's very personal. It's all up to what are you expecting? What do you want to do? What are your goals? And they differ for everyone. But
Mm-hmm.
the financial planning software now is really cool. Like I'm actually blown away with how advanced this stuff has become,
Okay.
and you can really test different strategies now. Like what happens if I need to invest 10,000 in my business? How is that going to affect my retirement goals?
Right.
And we can plug it into the system and it'll say doesn't affect you at all, or you
Mm-hmm.
might have to save more in the future to remain on track. So it really helps you make smarter financial decisions going forward as well, because you can always test all of these different shorter term goals on how
Mm-hmm.
it impacts the longer term goals so that you at least have the data to make a decision that makes sense for you. But again, we throw around the word clarity. I mean, it's clear as day once you've done the plan where you sit and whether you're on track and what you need to do to get there.
Amazing. I know you said the word budget and then you're talking about this financial planning tool. I think that's amazing. And I think the word that is coming or the phrase that's coming into my mind right now is the principle of living within your means.
Oh, yeah.
Yeah, right. And I know that can sound a little bit maybe old-fashioned, and I don't mean that as deprivation, but Kris, what do you think living within your means really looks like for a therapist who wants to enjoy life and build wealth?
Yeah. It's a challenging one, for
Mm-hmm.
sure, because you need to be disciplined.
Mm-hmm.
And not everybody's willing to make sacrifices. And this isn't just therapists. I mean, this is everybody. The other challenge is if there's a partner or a spouse, they're not always on the same page of what living within your
Mm-hmm.
means is. But I mean, I
Mm-hmm.
read something years ago when I was earlier in my career and trying to save for a home. And the quote went something like, live like nobody else now so you can live like nobody else later. And sort of the
Mm.
point
Mhm.
is do the bare minimum today so that you can put money away and save and reach your goals so that somewhere down the road you're
Mhm.
able to live a lifestyle that other people may not be able to because they didn't make the sacrifices early on. So, living within your means really means let's figure out how much money you make after tax and what is left for lifestyle expenses and what is left for your needs and wants.
Mhm.
And I'm a firm believer in making sure that you're paying yourself first. I mean, there's a whole pile of books and,
Mhm.
subjects on that matter. Pay yourself first. Um,
Yep.
so that's got to be part of it as well, as saving for your retirement or your goals, making sure your expenses are reasonable, not buying that fancy car just because your neighbor or colleague or somebody else has the nice car that you want, but does it really make
Mhm.
sense to buy that fancy car?
Mhm.
Have
Mhm.
those conversations. And again, when we have the plan and we see where we're at, it helps you decide maybe I can spend a little bit more on this thing and will it affect my plan? We can map that out for you through the financial planning process. So,
Mhm.
living within your means is really a discipline thing. Personal finance, I like to compare it to fitness training. Like we
Mhm.
can all be super healthy and
Mhm.
physically skinny or muscular, whatever it is that you want to be, but it's not easy to do without the discipline. I mean, it's easy to do, but a lot of us don't. And it's same with
Mhm.
personal finance and living within your means. I just find that not everybody does it. It's not that hard, but we just don't have the discipline sometimes.
Mhm.
So
Yeah.
having that coach sometimes to keep you accountable, I think helps.
Yeah, I love that saying, live like nobody else now, so you can live like nobody else later. And that idea of, living within your means. And what I'm hearing that hasn't quite been named yet is, saving early.
Yeah.
And I know we hear so much about why saving early is so important, but can you explain compounding in a way that actually lands for someone who's never thought about it?
Yeah, so there's a concept called the rule of 70. And
Mm.
what that means is if you take the number 72 and you divide it by the average rate of return of some sort of investment portfolio, that will tell you how many years it will take for your money to double. So the sooner you start investing, that 20-year-old who starts, and if
Mhm.
let's say they're earning 8% a year as an average rate of return, I don't know the math, but that's probably like every 7 or 8 years they would double their money. So that
Mhm.
20-year-old could, if they live till 95, could have seven, eight, nine chances to double their money. So that's kind of what they mean by compounding, where your
Mhm.
money continues to double the longer it's invested. The
Mhm.
person who starts at 50, same rate of return, their money might only double 4 or 5 times before they hit 95. So, those late stage doublings are really impactful. I mean, that 50-year-old who started at 60, maybe they saved up 100,000. When that doubles, it's 200,000. But if that 20-year-old started saving and by 60 they have $1 million, that next double puts them at 2
Mhm.
million. So
Wow.
it really shows the compounding. It's a good way to describe compounding when you're looking at the rule of 72. But yeah,
Mhm.
the earlier you start, I've read something once that a 20-year-old could put in, and I'm going to get the numbers a little wrong, but the concept still holds true, is you could put in $200 a month from the age 20 to 30 and then never save again, and someone could start at 30 doing $200 a month all the way until they're 65, and the 20-year-old would have more money at
Wow.
65 than
Mhm.
the 30-year-old.
Mhm. Mhm.
And they would have put far less money into the portfolio to begin with, but just with
Mm.
compounding and the time, it would have
Mhm.
grown to a bigger number than someone saving from 30 to 65. So just shows got to start early. Even something little is better than nothing, and you can just add
Mhm.
to it over time.
Mhm. Wow. Yeah, numbers like that or getting your head around them is the challenge, I think, for a lot of people. And when you're talking about investing, you're kind of talking about markets
Yeah.
and, that can be complicated. So how do you keep that simple? And is there a strategy, is it better to keep things simple or do you try and do something complicated or clever when it comes to investing? And why?
No, no. Well, it's definitely, I keep it simple. I mean,
Mhm.
I've been in the market since 99. So to me, it's very easy to understand because I've been doing it for so long. But I know for so many
Mhm.
people, it's kind of scary. I mean, I talked to a
Mhm.
therapist yesterday who's newer to Canada and she's got some money and she's ready to invest. And she's like, my sons tell me, just go do it yourself. And she's like, I'm scared. I don't understand. I don't know why. or
Mm-hmm.
don't know what to do. And so anyways, we like to keep it simple. I mean, we like to recommend index funds. These are really low cost. You just buy them. You can almost set it and forget it. And it just goes up over time as the markets go up. I think the biggest challenge is the psychology around investing. That's where people, I think, have the toughest time is dealing with
Okay.
the emotional stress of the ups and downs of markets. So
Mm-hmm.
again, that's the value that I like to bring to clients is walking them through that. I mean, I've gone through so many market up and downs over the years to coach people not to
Mm-hmm.
panic and sell and maybe sometimes
Mm-hmm.
don't stick your head in the ground and don't even look at the portfolios. And,
Mm-hmm.
because of that compound nature, you need to let it sort of go through those ups and downs. But yeah, keep it simple. Like buy an
Mm-hmm.
index ETF and just leave it alone. And so I used to work at a bank a long time ago, and they
Okay.
used to say the accounts that did the best were deceased people
Okay.
because there was no management, there was no one buying or selling or messing around with the portfolios. The money was invested and the person passed away and nobody knew this account existed. Those would perform better than all the clients that were alive who had people playing around with the portfolio, maybe selling when, markets
Mm-hmm.
went down and chasing the next best thing. And so
Mm-hmm.
keeping it simple and kind of leaving it alone is really the
Mm-hmm.
best strategy.
Yeah. Well, there's so many account types in Canada, and they can sound like alphabet soup, TFSA, RRSP, and corporate accounts on top of that. Can you give us like a plain language version and what each one is really for and the advantage that each one offers?
Yeah, I mean, there's, as you said, many of them. I mean, the main one we all know about is the RRSP, Registered Retirement Savings Plan. It's probably the
Mm-hmm.
most popular because when you contribute into it, you get a tax refund.
Mm-hmm.
So a lot of people like that because it can help bring down your tax bill each year. The other nice advantage of that type of account is just all of that growth over the years stays sheltered from taxes. So you're really compounding and you're not having to worry about any taxes the entire time until you're ready to make a withdrawal, which in theory is hopefully 65 or later.
Mm-hmm. Mm-hmm.
60 for someone who's very aggressive with their retirement plan, but you're just deferring all those taxes to a future year. We say they're a tax deferral account because at some point in time you will have to pay tax when you draw the money out of it. The theory behind it, though, is you're hopefully, when you put the money into the RSP, you're in a higher tax bracket than you would be when you're taking it out. So you'll save a higher amount of tax in the contribution years, and hopefully you're paying less tax when you take it out. So that's one of the big advantages. It's probably the most widely used
Mm-hmm.
account for saving for retirement here in Canada. A TFSA, that's your tax-free savings account, probably the most misused type of account. I kind of
Okay.
blame the banks a little bit for this because they've sort of trained clients to think that it should be looked at as a savings account where you just put your emergency savings or you're saving for a boat or a vacation. You put your 4 or 5 thousand in there in a high interest savings and then you pull it out. It's not
Mm-hmm.
really what it was designed for. And it's a very powerful account because everything that you earn, all the growth within that account remains tax free when you withdraw it. So it's a great way to build wealth and help finance your retirement as well because everything's tax free when you come out of it. The one big difference between that and the RSP is you don't get a deduction when you contribute to it. So you're contributing to it with after tax dollars, but
Mm-hmm.
then it grows tax free. So it's better used as a retirement savings plan than saving for your vacation next year. So those are the two main options for those who have incorporated. You've got that third option, as you mentioned, the corporate account that you can still invest in.
Mm-hmm.
This is another great tool for those who are incorporated. I'm a firm believer of still spreading it out over the various accounts.
Mm-hmm.
Um,
Mm-hmm.
you should be diversifying your portfolio. You should also be diversifying the account types that you're using because we just never know when the government's going to change tax rules.
Mm-hmm.
And we've seen that recently with corporations where tax rules were changed a few years ago or threatened to be changed recently, and then they pulled it back. But you just never know. It seems to be an easy target for governments going after corporate investment accounts. So it's still good to be diversified throughout all of them. There's a few
Mhm.
others. A new one that's the FHSA, which is the first time home buyers account.
Mhm.
It's a really cool account. It's kind of a hybrid of the RSP of a say. So any contribution into it gets a tax deduction, but
Mhm.
then when you pull it out to buy your home, it's tax free and you don't have to pay it back.
Oh, wow.
Yeah,
Interesting.
so it's a really, anyone out there who's thinking of buying a home, that would be the number one account I'd suggest you start using. So
Mm.
there's other types of accounts, RDSPs for those with a disability. There's benefits of that. There's the RESP, which is your education savings plan. Any of those with children who are trying to save for their education, you're getting
Mhm.
basically a 20% bonus if you max that out every year, which can go towards funding the kids' universities.
Mhm.
So lots of different options and different uses. And again, it helps to have a plan to know which one to use when. Because,
Right.
depending on your income, sometimes using an RSP makes more sense than a T of a say or vice
Mhm.
versa.
Yeah. Thank you for that explanation. It's really helpful. Understanding the tax deduction for the RSP, but then the tax-free savings account you're using after tax money, if I'm understanding this right. And then when you
Yeah,
take the money out, there's no tax on it, right?
right. Yeah.
Yeah. Yeah.
And that can be helpful later because if you make too much money sometimes,
Mm.
it becomes a bit of a juggling act in retirement, trying to manage how much tax you're paying. Because if you make too much money, they start clawing back your old age security, which to
Yeah.
me, every Canadian should receive. I don't like that they claw it back, but once you get to a certain
Mhm.
income, they start to claw that back. So
Mhm.
having a TFSA account helps you manage that a little bit because you can take tax-free money that doesn't
Oh,
count as income, so you can keep yourself
mhm.
under that threshold and not get clawed back.
Right. Right. Now, you talked a little bit about incorporation, and that is really one of those topics that therapists hear about and immediately can feel like they should be doing. But
Mhm.
incorporating isn't right for everyone. So, how do you help someone figure out whether incorporating actually makes sense for them?
Yeah, so I mean, we will have a deep conversation about it because there are a lot of factors to consider. I've
Hmm.
had so many therapists come to me saying, "Well, everyone says I need to incorporate."
Mm.
I'm like, "But
Hmm.
why? Like, where
Hmm.
are you at in your career? What are your goals? What are you trying to achieve? What's going on in your life?" There's just so much more to ask than should I incorporate or not. But there's all these rules of thumbs. One of the main ones that I, sort of subscribe to is, are you earning more money than you need to cover your lifestyle expenses?
Hmm.
And if that is the case, then that is usually the first trigger, I think, to start thinking about it.
Hmm.
Because as a sole proprietor, you have to pay tax on every penny that you make, whether you use it or not, or whether you
Hmm.
need it to fund your lifestyle or not.
Hmm.
When you have a corporation, I kind of like to think of it like pouring a cup of coffee. You can decide how much income you want to take that year, and you're only going to pay tax on that amount. You can leave the rest in the company, and the
Hmm.
company tax rates are much lower. So there's a lot of after tax money left over that can be left in the company and invested. So, that's usually the first thing I look at is, do you have any money left over after paying for your lifestyle? Because if not, there really isn't a whole lot of point to being incorporated. Your expenses are higher when you're incorporating. I mean, your tax bill is definitely higher. So
Hmm.
it has to be worth it just to cover the higher expense. There's more administration. I mean, even your college, you have to register with them annually,
Hmm.
pay them a fee as well annually. I can't remember if it's like $400 a month or something in that nature, but there's just all these added expenses. I talked to a therapist recently who's very successful financially, definitely ticks many of the boxes that one would think it made sense to incorporate. She's been incorporated for 5 years and she regrets it
Mm.
because she's like, my kids are going to university. I'm paying for university costs. I'm still spending all the money that I make. Like I have all this extra headache of the corporation and fees and tax return. Like, so she's just, wishes that she had more analysis, I guess, put into the decision before she decided to do so. So, it's
Mhm.
not one of those things that everybody can just say, do it now or not. Like, I think there needs to be more thought put into it. There are some tax strategies that, those who are not incorporated have that an incorporated person doesn't. So
Mm.
there's other things to consider as well. I think a full analysis needs to take place and really be clear on sort of what you're trying to achieve in the short term to make sure that incorporation makes sense for you.
Right, right. And that's, I hear that so often when we're talking about incorporating, whether I'm talking with accountants or lawyers, is that it's not cut and dry. It's really based on the individual's situation as to the timing on when it makes the most sense to incorporate.
Yeah. Yeah,
Hmm.
and I'm still not incorporated. I mean, personally, I'm not a therapist, obviously, but we have
Hmm.
similar businesses, and
Hmm.
it just still, to me, hasn't made sense to do so.
Right. Yeah.
Even though all my other colleagues who do what I do are incorporated and are telling me every day to do so, it doesn't always make
Hmm.
sense for everyone, depending on, what strategies you're trying to work
Yeah.
through. So,
Hmm. Okay. Yeah. Thank you. Thank you. Now, for the therapist who's listening to this right now and maybe feels like they're behind on their finances or feeling overwhelmed just thinking about this, or maybe guilty thinking about all this, what's the honest, grounded first step that you would give them to try and do this week?
what is the first thing I would do? I would probably spend some serious time trying to get yourself organized. And when I say that, I mean figure out what your expenses are and what your income is and just get an idea of where you are right now.
Hmm. Hmm.
I think that is the starting point that typically when I work with someone anyways, it's like, let's get organized first.
Hmm.
Before
Hmm.
we do any planning, before we do any strategies, before we do anything, let's just get organized.
Yeah. Well, and that makes sense because then you're making decisions from a place of knowledge, right? When you know what your income is and what your expenses are. I think that
Yeah,
makes sense.
exactly.
Yeah,
And
for.
it starts to build the foundation and,
Hmm.
the confidence starts to come, the clarity starts to come, the anxiety starts to, drop, and then, you can move forward from there.
Hmm. Yeah, thank you, Kris. I think, the biggest gift in this conversation is that permission piece, the reminder that wanting to build wealth doesn't make you any less of a caring, committed therapist. And if anything, I think it allows you to keep doing this work for the long haul. And so, for everyone who's listening, if this conversation has you thinking about your own money story, please go and connect with Kris. You can find him at Therapist Financial. The website is therapistfinancial.com. And Kris offers a short fit call to talk with him and see what your own situation is like. And I'm going to make sure that the links are in the show notes below so they're easy to find. So, Kris, thank you so much for being here today and for making this feel so doable.
Thank you. Thank you for having me.
Yeah. And for all of you who are listening, thank you for spending this time with us. And if this episode has taken a little bit of weight off your shoulders, please feel free to share it with a therapist friend. Hit subscribe, and I will see you next Monday. Take care. Thanks so much for tuning in to the Build Your Private Practice podcast. If today's episode resonated with you, I'd love it if you'd subscribe, leave a review, or share it with a fellow Canadian therapist who needs this. And remember, the work you do matters. Keep showing up, keep holding space, and keep building a practice that works for you. If you're looking for practical tools or support to grow your practice with more clarity and confidence, head to buildyourprivatepractice.ca. There's lots waiting for you there. I'll see you next time.